Many investors like to buy funds. They consider it to be an easier way to invest than perhaps setting up their own portfolio of diversified equities or other securities. What can possibly go wrong? You hand your money over and either a fund manager manages your money for you, or you invest in something that passively tracks an index or sector. Well, in this video, I want to point out that it's not quite as easy as it first seems. You need to be careful when you're buying funds. You need to understand what you're buying. And I want to point out 5 red flags, or to put it another way, 5 bits of homework that you should try and do, 5 tests to apply, some easier than others, before you assume that all funds are created equal, because I'm afraid they're not. So, with no more ado, the advantages of funds. Why do people buy funds when you could just go out and buy the underlying securities yourself? Well, there are some advantages. The expertise of the fund manager. All right, so if it's an active style of fund, you're getting someone with experience in a particular market, stock picking expertise, all right, in a market sector or geography that you may not fully understand or have the time to get to grips with. Access to a broad range of sectors and geographies, some of which you may not have thought of before. So there are funds that will get you into Russia, for example, funds that will get you into sectors you may not have come across, funds that can follow different strategies. All right, so there's stuff out there in the funds world that frankly you may not think of yourself or may not want to get involved in directly yourself. Diversification. So a fund will try and spread your money, making sure that you don't have all your eggs in one basket. Some do that job better than others, I have to say, but the principle is that. And low maintenance holdings. So rather than having to manage a diversified portfolio of stocks and or fixed income securities and so on, basically you're just holding sort of one security. You're holding units, for example, in a unit trust or shares in an investment trust company. But it would be a mistake to think, well, it doesn't really matter which fund I pick once I know where I want to invest because they're all roughly the same, they all do roughly the same job. No, they don't. And that's true of active and passive funds. So here come my 5 tests and my 5 kind of things that might make you nervous if you were going to put your money into a fund that demonstrates one of these characteristics. Right. Now, just a word of warning, all right, if you make the wrong decision, you get something that's called style drift. That is, funds that wander away from both the mandate you think they're following and, of course, the performance you're expecting, all right? So these are basically, these warning signs, these red flags are a way of reducing the risk of what I call style drift and poor performance. All right, I'm not saying you would never buy a fund that demonstrates any one of these, but if you see several of them together, watch out. So what are they? First one's a lack of consistency. All right, very important that you check who's at the top, check their track record, and if, has been the case recently with some quite high-profile funds, if the person at the top is about to change, do not assume that their successor will follow the same strategy. Fund managers all have their own preferences. They all have their own stock selection process. All right, so just keep an eye on what's happening at the top and just make sure that you understand who's running the fund and what their investment philosophy might be before you dive in. All right, there's number 1. Number 2, lack of disclosure. It's really important with funds, which could be buying a whole range of different securities, that you know what's under the bonnet, as I've called it. It's really important that you can get to an understanding of the strategy. And if any of this is kind of vague, all right, because funds produce quite a lot of documentation about what they do, key fact documents, for example, then watch out. Strategy. How are they going to make money for you, to translate that? What's the geographic focus? And just watch out for that, because sometimes, and this can apply to passive funds as much as active funds, the geographic focus can be a lot narrower than you think. They'll claim to be a global fund specialising in a particular sector, and when you look up actually where they invest, you find out that 85% of the funds in North America. Now that might be fine. You might want that degree of North American exposure, but you need to know that's what you're getting. Same with sector focus. Just watch out. I mean, a classic example is people who say, well, I'll just passively track the FTSE 100 index. Well, the FTSE 100 index is concentrated in a handful, 3 or 4 sectors. A huge proportion of the value of the FTSE 100 is focused in just really sort of 3 to 4 key sectors. And if you want exposure to those, great. Buy the index, for example, but if you don't, you might need to go shopping elsewhere. So what I'm suggesting is that piling into even an index doesn't give you the degree of diversification that you might think it will. So again, look under the bonnet here. Top holdings, yeah? Which companies has the fund invested in? I've seen many a passive fund, for example, skewed very heavily towards financial services firms, or skewed towards cyclical firms or skewed towards defensive firms. There's nothing wrong with that, but you need to make sure that, if you like, the marketing description matches what you think the fund's going to deliver. And charges, okay? Just be aware that different styles of fund levy different types of charge, for example. So, if you're going to go into the world of hedge funds, they tend to have their performance-related fees. Private equity funds are the same. If you're looking at a more sort of what I call standard mainstream fund, just make sure you understand, is there an initial charge, is there an exit charge, and what's the annual ongoing management fee, all right? So, lots of things, and it sounds like a lot of homework, to check before you buy a fund, okay? And just be aware, at the bottom there, some funds do better in certain market conditions than others. All funds are not created equal. Are you looking at a fund that performs well, generally, outperforms when the market's rising? Is this a fund manager who's good in neutral markets? Okay, is this a fund that can take down bets on the market? That's called long and short, and so on. Very important to get to grips with all that before you pile your money in. So know what you're buying. That's true of most things in life. Lack of size. This is a fairly quick point. Very small funds, all right, can get quite expensive in cost terms. You just watch out for that. If a fund's losing investors, and this is something that people buy funds and forget about them, tuck them in the top drawer, but do monitor your fund holdings, or make sure someone's monitoring your fund holdings, because as funds start to shrink, that can disproportionately influence the amount of your money that's gobbled up in charges. But this just goes to show, no rule is absolutely cast iron. Watch out for the opposite. Open-ended funds, for example, can suck in money from investors almost ad infinitum. There's no limit. They're not closed-ended, there's a clue in the name. So they can keep pulling in money, keep marketing, get huge. And like any organisation, there comes a point where a fund is arguably too big to be making decent returns for all of its investors. Okay? You see this with even the legendary Warren Buffett. In the early days, his returns were spectacular because he was a little bit off the radar. He was able to do things that other investors couldn't do. But as that fund grew, sure, the performance has been decent, but arguably, he's never managed the same returns as he did back in the early days when he was sort of arguably more nimble, tighter ship. Okay, just watch that. Lack of liquidity. Now, this again is about getting under the bonnet. This is about saying to yourself, do I understand what the fund's invested in? Why does it matter? Because two things really. If market conditions change, can the fund manager switch? How nimble is the fund? Can the fund move from one asset class to another? All right, can it go from sort of an aggressive to a slightly more defensive stance? Can it move into cash and bag out again if it needs to? All right, and if things go wrong, and hopefully they won't, I mean, you're a long-term investor, hopefully, but if things go wrong, can the fund liquidate assets and how quickly to meet payments back to investors who are sort of stampeding for the exit? Now, here's where basically with an open-ended style of fund, this can become more of a problem. I cover this in another video. They're sort of obliged to meet redemptions. With a closed style of fund like an investment trust company, okay, it's not quite such an issue because the shares you buy are traded on a public market and exchange, and therefore investors can usually get out, albeit the fund might trade at a discount to its underlying net asset value. That was a bit of a technical explanation, but I'm just suggesting to you that you need to understand the liquidity of the underlying portfolio. That's important too. And the final one, lack of control. Now, it's not easy for retail investors to measure some of this stuff. You might need a bit of help, but the size and strength of the risk committee and who does it report to? You don't want the poacher reporting to the poacher, all right? The risk committee, if you can get any information on it, shouldn't be reporting to the fund manager for fairly obvious reasons, I'd have thought. The quality of counterparties and custodians. When Lehman Brothers collapsed, going back a few years, the ripple effect was significant, all right? People needed to be checking whether Lehman Brothers were a counterparty on funds that they were holding, and if so, there were ramifications, okay, which some people are still feeling the effect of even today. So, quality of counterparties and custodians, something that, again, not always easy to get information on straight away, but you should dig around for. Turnover of key staff, mention the people at the top, but equally important, turnover of key staff includes turnover of sales teams and so on. Organisations with high staff turnover can be the ones you don't necessarily want to have your money with. Quality of communication, how open is the fund, how regularly does it communicate, okay, how easy is it to get information out of the fund, and consistent profitability. All right, you want a underlying fund, company or structure that is stable, basically, as a long-term investor. All right. Now, I'll put at the bottom, these can be a little bit tough to to assess as a retail investor, but the more information you can get, the better. Okay, fairly fast tour there, and quite a few topics where I sort of skated over the detail. So if you want more on some of those topics that are background to this video, what are open and closed-ended funds, gives you more detail on unit trusts versus investment trust companies. What are ETFs all about? More basics on the passive style of fund I mentioned earlier, and what makes hedge funds different for those people who'd like to find out more about the world of hedge funds. Any questions or comments on those red flags or on those other videos, please email me at the usual place.